Welcome to the Canadian Investors Course, Session 3, Introduction to Equities Commentary. This is further information on the Introduction to Equities, as before. Please note that, as always, page 2 has the terms of use and disclaimer, and we request that you read it. Slide 3 is a history of the Fed funds rate since 1979, and it seems that interest rates appear to correlate to the height of the various Fed fund chairs. Paul Volcker was a tall man at 6'7". Janet Yellen is a not very tall lady at 5'0". The session concentrates on the two ends of the fixed income yield curve. The short end of the yield curve, 2 years or less, and the long end of the yield curve, 10 to 30-year bonds. If you haven't taken session 2, it'd be a pretty good idea to do so at this point, because understanding the bond market is critical to managing a stock portfolio. So let's look at the extreme ends of the yield curve. These two extremes are driven and influenced by different forces. The short end is highly influenced by the Federal Reserve, also called the central bank. The long end is influenced more by the market made up of investors. If you look at a chart of the yield curve, it's you've got yield on the y-axis, the vertical axis, and maturity on the x-axis, the horizontal axis. And if you look at a nice rising curve is called a normal yield curve. In Canada, the Bank of Canada governor determines interest rates and maturities less than a year or less. The Bank of Canada rate is related to 90-day interest rates. In the U.S., the Federal Reserve chairman determines the Fed funds rate, which deals with interest rates of less than 1 year. The long end of the yield curve in both countries, or the rest of the world for that matter, is made up of 10 to 30-year bonds. Please review session 2 for how bond prices are influenced by changes in interest rates. The question is, what influences the changes in interest rates? Factors that influence interest rate changes are inflation, a strong economy, low unemployment, strong GDP growth, deficits, credit ratings, and currency movement, weak or strong. The central bank will raise or lower rates on the short end of the yield curve based on the same factors as above. They raise rates to cool off the economy, and they lower rates to stimulate the economy. So let's look at different yield curve formulations. First of all, a normal yield curve is one that goes from low to high smoothly with no pullbacks along the way. A steep yield curve is one that does so in an extreme way. In other words, interest rates rise a lot for different maturities. In other words, for between one maturity and another, there's a significant move upwards in interest rates. That makes for a steeper curve. And that's very, very positive for the economy, very stimulative. An inverted yield curve slows the economy. That's when short-term interest rates are higher than long-term interest rates, either through a section of the yield curve or across the whole yield, the entirety of the yield curve. So further discussion of yield curve formulation will be in future sessions. It's very important to the construction of an investment portfolio, and the important thing to realize is that when the yield curve inverts, in other words, when short-term rates are higher than long-term rates, it very often leads to a recession and or a bear market. Please see the next chart to understand this a little bit more clearly. If you look at the charts, these charts of the S&P composite compared to Fed fund rates, you can see when rates were when the yield curve was inverted and how that affected the markets. In fact, it can be said that although an inverted yield curve does not necessarily absolutely guarantee a recession. There has never been a recession in recent history that was not accompanied by an inverted yield curve. And typically, when the yield curve inverts, that's a good time to reduce equity exposure. That's the end of the commentary for session 3.